as I think about where we are in the market, I think by and large, we can characterize it as momentum for sure, but an uneven momentum. We're seeing strong profits. We're seeing higher expectations, which are driving markets right now, but a very, in my sense, narrowing margin for error. This market is increasingly priced to perfection, and we're just seeing an uneven momentum in the market. And let's go through it, and I'll try to highlight why I say that. Just in terms of broad market equity performance globally, the S&P 500 is up 9.5% year to date, a little bit less than that now. The Dow is up 9%, NASDAQ's up 9%. The Russell 2000 is up twice that amount, up 18% year to date. We've just seen an expansion of participation in the market, less concentration. We've seen the Russell 2000 underperform over the last few years. Valuations get a little bit lower, perhaps out of balance, and we've seen a rally in smaller cap stocks, which is reflected in the Russell 2000. The European stock index is up almost 10% year to date. The Shanghai Composite is down, and it's the only area, broadly speaking, that we see negative performance in the market. In large part, I think to understand why that might be as an outlier, the Shanghai index is not made up of China's best companies, most profitable companies. Those by and large trade on markets in Hong Kong or in Europe or some even in the United States. The Shanghai Composite, to understand the performance, I think it's important to remember that they are large companies in this index that primarily are aligned with the government, reliant on the government, real estate, large industrial manufacturing, those kinds of things. And the government in China had promised massive infusions of capital and support into the market. The index rallied last year, and that support into these businesses have just not materialized. So it's not a reflection overall of China, but of this segment of companies that's included in the composite. But nonetheless, it's the only broad market index that we follow on a regular basis that's negative. If you look at all of the investment opportunities globally, the All Country World Index, on average, equity assets are up 10% year to date. So we're having another really good year. We're off to a great start. Just to give you a little bit more context to broaden the aperture just a bit, if we just look back a couple of years, you can see the performance of the S&P 500. It just gives you a sense of the trajectory over the last couple of years. As we look at sector performance, you can see that the S&P 500, the information technology sector, this includes all of the mega cap, large technology stocks. Much of the Magnificent Seven are held in this sector. It's just remarkable over a 10-year period, up over 7.5 times. Year to date, up 15%, 1 year, 25%. This really has been the driver, a big, significant driver of the S&P 500 index. We also have benefited from a very robust energy sector, up 32% year to date. So this just gives you kind of a sense of where the returns are coming. The industrial sector has done well with the build out of data centers and other heavy materials, construction and the like. But this gives you a sense of where the returns for the S&P 500 are coming from. Most of this is being driven by record corporate profitability, and expectations have continued to be strong, and earnings have supported those expectations. And it's all very positive in terms of earnings expectations, which really has driven the market. Asset prices, by and large, are not higher because people are willing to pay more for every dollar of earnings. In other words, the PE ratios have not gone up. It really is the level of corporate profitability. And I think that it's all positive, but I think that it's important that we look at corporate profitability in a more nuanced way as we think about kind of this margin for error and the markets being kind of priced for perfection. If we look at uh, corporate profitability for the S&P 500, it is increasingly driven by large cap mega growth technology companies. That revenue is about 33% of the overall index. And technology companies have traditionally had twice the margin of traditional holdings in the S&P 500. Think about it. If you're a technology company and you have a platform, to add one incremental user revenue, you don't have to add more inputs in terms of people or otherwise. And the profitability margin is just so much more for a technology company. Technology is representing more and more the S&P 500. With larger companies, we see a greater ability to have pricing power. That's been part of the corporate profitability. And then also just taxes, marginal corporate tax rates have really fallen off. So yes, earnings are very supportive of asset prices, and it just makes me wonder how resilient this is in terms of a support for the market. As we look at earnings expectations going forward, you can see that the street analysts have earnings, growing at over 25% in the current year. That falls down to just something over 15% next year. So I do think that we'll see a tapering of earnings, but for right now, earnings really are driving the stock market, and it's been a very positive story. I think that this hypothesis of corporate earnings in part is related to or has a thread of the AI investment and productivity. Part of it is there's a lot of activity in the market that is being driven by AI investment, whether it be data centers, whether it be construction, whether it be water systems, utilities, energy. There's so much being affected by investment in AI um, that we really have come to a place where it needs to be justified in terms of returns on investments. So far, earnings have big technology earnings have justified or at least shown earnings from these investments, primarily in cloud. Primarily, that's the source of the revenue right now. But you can see here, and I just think it's really interesting as we look at AI investment and look at some of the parallels of other nascent technologies historically, whether it was the railway or the .com. You can see the level of investment in each of those big pushes, infrastructure over history, and just a relative kind of comparison of just how big the AI investment is right now. It's going to be great if it pays off, but it's yet to be seen. In terms of fixed income, the U.S. Treasury curve is still positive in terms of its upward sloping nature. 10-year Treasuries are yielding 460. Uh, 30-year, yeah, here we are, for around a 460. And just to give you a comparison in terms of 2-year Treasury is at 425. So we do have a normally sloped yield curve. 30-year mortgages right now are at 670, which is about 200 basis points over 10-year Treasuries. That's a historically very large delta in terms of mortgages to Treasuries, 200 basis points. I just think it's just an interesting note. It's affects the housing market, especially first-time buyers, and just something to follow. As we think about yields, I think one of the interesting things that's happened, and uh, over the last years, especially in a downward um, with lower interest rates, the regime that we've just experienced is reaching for yield. And I just make note that investors today are willing to take less yield for a unit of risk. So if you just look at this chart, it just shows different maturities, 1, 5, and 10-year. The bright blue represents treasuries. The green is triple B corporate bonds. And the delta, the difference between what someone will accept the risk of a triple B relative to a risk-free asset, the Treasury, at 1 year, it's about 50 basis points delta. 5 years, it's about 80 basis points. And then at 10 years, it's about 1%. So it just, I think, talks to the pressure under which fixed income investors are looking for any opportunity for incremental yield and increasingly being willing to take more and more risk for that yield. I think the big themes as we think about the market right now, and certainly direct you back to Chris's quarterly letter. I thought it was really well written, and many of these themes are highlighted in his letter as well. Things to be watching for is this AI, artificial intelligence, the monetization. Will the investments be justified by productivity, ultimately by earnings and that transition? So it's a continuing story. I think that we've gone through another quarter. We've just passed big tech earnings. They were supportive, especially companies like Microsoft. So we will continue to watch that. Energy costs will continue to be, I think, a major factor, especially as we are at war with Iran and the Strait of Hormuz, and now an embargo on the Red Sea and alternatives to Strait of Hormuz. Pricing and energy is affects everything that we do. A head of lettuce has to get here somewhere, trucking and energy, and it's just a part of costs. And energy will be an important determinant of what happens in the market, just in terms of cost and how effective or how comfortable the consumer is and their spending. Despite inflation, despite low sentiment among consumers right now, consumer spending has really hung in there quite robustly. And as we know, a big part of the US GDP is dependent on consumer spending. Will they continue to spend at these rates going forward? It's yet to be seen, but really important. And then, as we talked about a few minutes ago, corporate earnings and what happens. Does this trend continue? Does it moderate? And it would be a really important input for risk assets, certainly going forward. In terms of the economy, the Fed, some things about global politics. We just had a print of June inflation. It was at 3.5%. It was down. I think that it reflects there was a ceasefire at the time. Oil prices had come down, and there was some sense of relief. We did see certain costs come down as a result of that. It's reflected in the CPI. Where we go from here, we'll see. Kevin Warsh has a tough challenge in front of him. He wants to be seen as tough on inflation, and that would argue for raising rates. He had 3 members of the Fed vote to raise interest rates at the last meeting. He's under pressure internally, but also externally from the administration. The question is will we see a rate increase in September for Warsh to kind of burnish his anti-inflation bona fides, or are we getting too close to an election? And so all eyes are on the Fed in September, and that's going to be a really important indicator and kind of catalyst for how the markets end the rest of the year. But CPI inflation continues to be higher than the Fed would like, and continues to be an important thing that we follow. The weight of inflation has certainly shown in the most recent GDP numbers that we saw recently. You see there's a kind of a short-term downtrend in terms of GDP. We would expect summer months that there would be an uptick, certainly going into the fall, but the productivity broadly has fallen and is something to watch. In terms of the Fed, I spoke a moment ago of what the Fed might be doing. The Fed funds rate is now 350 to 375. I think the market is expecting a increase in September. They were pricing that into to securities. We'll see what happens, but I think that it's much more likely that we would have an increase than a decrease in interest rates. So the Fed's really under pressure right now. What's not putting the Fed under pressure is labor, and very often, the Fed's trying to solve for both the strength of the labor market, full employment, and asset prices. And the labor market looks pretty positive, healthy right now. Unemployment is at historically norm. And what we're finding is that the economy has really become a slow to fire, slow to hire. People are staying put, and it's fairly static. The employment market is not as dynamic as we've seen it in years past. But the saving grace is that productivity and output really has accelerated relative to hours worked. So for 1 unit of labor or input of someone's time, productivity and output have really increased significantly, and it's been a big part of corporate earnings. And the AI proponents will point to a graph like this and say, here's some proof. Federal debt, we talk about this once in a while. Federal debt's now above 100% of GDP. It's a milestone, and it's an important one. It's projected to go even higher.